Hey, welcome back. Have you ever placed a trade that looked absolutely perfect on the chart? Everything lined up, and then the moment you clicked buy, the price immediately reversed and went the opposite direction. And you sat there thinking, how does that keep happening? It is not bad luck, it is not a coincidence, and it is definitely not random. There is a reason it happens, and once you understand that reason, you will never look at a price chart the same way again. Today, we are pulling back the curtain on how smart money actually operates in the crypto market. Smart money means the big players, the institutional traders, the hedge funds, the market makers, the whales with millions and sometimes billions of dollars moving through the market. These players do not trade the way retail traders do. They have completely different goals, completely different tools, and a completely different understanding of how price moves. And here is the uncomfortable truth. A lot of what they do is specifically designed to take money from retail traders like you and me. By the end of this video, you will understand who smart money is and why they move price the way they do. You will understand the specific traps they set for retail traders. You will be able to spot those traps on a chart before you fall into them, and you will know how to position yourself with smart money instead of against them. Let us get into it. Who is smart money and why do they move markets? First, let us be clear about who we are talking about when we say smart money. Smart money refers to large institutional traders, hedge funds, proprietary trading firms, and high net worth individuals, commonly called whales. These are entities that move massive amounts of capital through the market. We are talking about positions worth millions or hundreds of millions of dollars. Now, here is the fundamental problem that smart money has that retail traders do not. When you want to buy $1,000 worth of Bitcoin, you click buy and your order fills instantly at the market price. No problem. But when a whale wants to buy $50 million worth of Bitcoin, they cannot just click buy. If they put a $50 million market order in, they would instantly push the price up dramatically before their own order even filled. They would be buying at increasingly worse prices the whole way through. This is called slippage, and it costs them enormously. So smart money cannot trade the way retail traders trade. They have to be far more strategic about how and when they enter and exit positions. They need liquidity. They need a large pool of buy and sell orders on the other side of their trade to fill their massive positions without moving the price against themselves. And this is where everything gets interesting because smart money does not just find liquidity, they manufacture it. They create situations that cause retail traders to place their orders exactly where smart money needs them to be. Understanding this one concept changes everything about how you see the market, how retail traders think versus how smart money thinks. To understand smart money tactics, you first need to understand how retail traders think, because smart money exploits those patterns completely. Here is how the average retail trader thinks. They look at a chart. They see a clear support level where price has bounced multiple times. They think this is a safe place to buy. So they place their buy order just above that support level and their stop loss just below it. They look at a chart and see a clear resistance level where price has rejected multiple times. They think this is a good place to short or take profit. So they place their sell orders right at that resistance level. They see a chart pattern forming, maybe a triangle or a flag. They read about it online. They enter the trade in the expected direction and place their stop loss at the obvious invalidation point. And here is the critical insight. Every retail trader following these same rules is placing their orders at the same obvious levels: below support, above resistance, at pattern invalidation points. This means those levels are completely visible and predictable to smart money. Smart money knows exactly where retail stop losses are clustered. They know exactly where retail buy orders are sitting, and they use this knowledge to their advantage. Instead of trading with the obvious pattern, smart money often pushes price into those obvious levels first. They trigger the retail stop losses, collect the liquidity from those orders, and then reverse the price in the direction they actually intended to go. This is why your perfectly set up trade reversed the moment you entered. You placed your order exactly where smart money needed it to fill theirs. Liquidity, the concept that explains everything. Liquidity is the single most important concept for understanding how smart money operates. So let me explain it clearly. In trading, liquidity means pools of resting orders in the market, orders that are sitting there waiting to be triggered. Stop losses below support levels are liquidity. When price sweeps below support, it triggers all those stop losses. Those stop loss orders become market sell orders. Smart money buys those sell orders. That is their fill for a long position. Stop losses above resistance levels are also liquidity. When price pushes above resistance, it triggers stop losses from short sellers and activates buy stop orders from breakout traders. Smart money sells into all of that buying. That is their fill for a short position. The key insight is this: price is constantly drawn toward liquidity. Smart money pushes price toward clusters of orders so they can fill their own large positions. This is why the market so often does the opposite of what seems obvious. The obvious levels are exactly where the liquidity is sitting, and liquidity is exactly what smart money needs. Now, let me give you a concept that ties all of this together. It is called a liquidity sweep or a stop hunt. A liquidity sweep happens when price briefly pushes beyond a key level, triggering all the stop losses there, and then immediately reverses back in the opposite direction. You have seen this happen. Price drops just below a key support level, triggers everyone's stops, and then rockets back up. Or price pushes just above resistance, triggers all the breakout buyers, and then immediately falls back down. That is not random volatility. That is smart money collecting liquidity before making their real move. Once you can recognize a liquidity sweep happening in real time, you have a significant edge over traders who do not understand this. The smart money cycle: accumulation to distribution. Smart money does not just buy and sell randomly. They operate in a clear cycle that repeats over and over across different time frames and different coins. Understanding this cycle is one of the most valuable things you can learn. The cycle has four phases. Phase 1 is accumulation. This is where smart money quietly builds their position. Price is low, sentiment is bearish. Most retail traders are not interested or are actively selling. Smart money does not just buy all at once. They slowly accumulate over time, absorbing sell orders from retail traders who are giving up. The market looks flat or choppy during this phase. Nothing exciting is happening. This boredom is intentional. They do not want retail attention during accumulation. Phase 2 is markup. Once smart money has accumulated enough, they start pushing the price up. This attracts retail attention. FOMO begins. More buyers enter the market. The news starts turning positive. Price rises steadily. Smart money is still buying during early markup, but they are also beginning to slowly distribute, meaning sell, their earlier accumulated positions to the incoming retail buyers. Phase 3 is distribution. Price has risen significantly. Retail traders are excited and buying heavily. Smart money is now actively selling their entire position into this retail buying pressure. The market may still look bullish during distribution. Price might even make new highs, but smart money is exiting. They are selling to retail traders who are convinced the price is going to keep going up forever. Phase 4 is markdown. Smart money has exited, the buyers have dried up, price begins falling hard. Retail traders who bought at the top are holding losing positions. They eventually panic sell at the bottom, and that panic selling at the bottom feeds the next accumulation phase. The cycle repeats. Understanding which phase the market is in gives you a completely different perspective on every price move you see. How to spot smart money moves on a chart. Now let us get practical. Here is how to actually identify smart money activity on a real price chart. Signal number 1. The liquidity sweep followed by a reversal. Look for price to push aggressively beyond a key support or resistance level, a level that has been tested multiple times and is clearly visible on the chart. Then, watch for an immediate reversal back through that level with strong momentum. The sweep below support, followed by a strong bullish reversal, is one of the highest probability long setups you will find. The sweep above resistance, followed by a strong bearish reversal, is one of the highest probability short setups. The key is the reversal must happen quickly. A slow grind back is not the same as a sharp reversal. Smart money reversals are typically fast and strong because the buyers or sellers who needed those orders are done filling. Signal number 2. Volume anomalies during accumulation. During the accumulation phase, watch for high volume candles that barely move the price. This is called absorption. Smart money is buying heavily, but the price is not rising because they are absorbing all available sell orders. When you see big volume with small price movement in a low price range, accumulation may be occurring. Signal number 3. The change of character. After a series of lower highs and lower lows in a downtrend, watch for the first higher high to form. This is called a change of character. It signals that the balance between buyers and sellers may be shifting. It is often one of the first signs that smart money has finished accumulating and is beginning to push price higher. Signal number 4. Consolidation before a big move. Smart money needs time to build positions. Look for periods of tight, sideways price action after a significant move. This consolidation is often smart money either accumulating for the next leg up or distributing before the next leg down. The direction of the breakout from consolidation usually reveals which one it was. Let me bring this together. Smart money operates completely differently from retail traders. They need liquidity to fill massive positions. They manufacture that liquidity by pushing price into obvious levels where retail orders are clustered, triggering those orders, and then reversing. The accumulation, markup, distribution, and markdown cycle repeats constantly across all time frames and all markets. You can spot smart money activity through liquidity sweeps followed by reversals, volume anomalies, changes of character, and consolidation patterns. And you can trade with smart money instead of against them by avoiding obvious stop loss placement, waiting for sweeps before entering, trading in the direction of the higher time frame trend, and following the relationship between price and volume. The market is not random. There are players with far more capital and far more information operating in it. The smartest thing you can do is learn how they operate and stop being the person whose stop they hunt. If this video opened your eyes to how the market really works, please hit that like button and subscribe. This is the kind of content that genuinely took years of experience to put together. Drop a comment below and tell me, have you ever been stop hunted out of a trade that then went in your direction? I guarantee most of you have. Tell me about it below. I will see you in the next one.